In this video, I will share with you two ETFs that you need to know. One has consistently outperformed the market while the other has matched the market's return with ultra low cost. And here's the part most people actually miss. These two ETFs take two very different paths to get there. One focuses on pure growth and the other one on simple efficient tracking. Together, they show you two smart ways to grow your wealth without having to pick individual stocks. Stick with me because once you see how these funds work, you will understand why so many investors hold them side by side. Hi, my name is Mutibi Ahmed. I am a chartered financial analyst and qualified accountant with a decade of investment banking experience. And I make videos to simplify investments and personal finance. The number one fund that we are discussing here is called Capital Group Growth ETF. The ticker is CGGR. What is interesting about CGGR investment strategy is that the fund managers aren't locked into one strict style. Most of the money goes into big, fast growing US companies, but they can also invest overseas if they see good opportunities. In fact, up to 25% of the money can be invested outside of the US as per the fund's investment strategy. The fund started in February of 2022 and already has accumulated about $16.5 billion of assets under management, which is a sign that a lot of people actually trust this ETF. Now, the fun part is how CGGR has performed. Over the past year, the fund grew by 24%, while the S&P 500 grew by 15%. Over the 3 years, it returned average 27% per year as compared to S&P return of 20%. Since its launch in 2022, its average return has been 17% per year compared to an average 13% return for the S&P 500. In simple words, CGGR has beaten the market. If you like my video, please hit the like and subscribe button. Like all funds, there is a cost for professional management. In the case of CGGR, the expense ratio is 0.39%. That means if you invest $1,000, you will pay about $3.9 per year in fee. In ETF world, fee below 0.5% is considered low. Compared to many mutual funds, CGGR fee is actually fairly low. Now, let's see the breakdown of where the $16.5 billion of assets of CGGR are actually invested. About 91% invested in the US companies, which makes sense because US companies has many large world-leading firms. Around 4% in Canadian companies and smaller amounts are in Europe, the Middle East and other emerging markets. A tiny slice, about 1.4%, is held in cash, which gives the manager flexibility to deploy this cash into suitable opportunities they can find around the world. Looking at CGGR ETF investment breakdown by company size, almost 78% of the ETF assets are invested in large companies. Think of giants like Microsoft or Meta, while remaining 22% are invested in mid-size and small-size companies. So the overall, this CGGR ETF portfolio is tilted towards well-established names. Now looking at the sector breakdown of CGGR, about 28% is invested in technology, 19% in communication services, 15% in consumer discretionary, 11% in industrials, 11% in healthcare, and 8% in financials. The top stock holdings of this ETF are Meta with an investment allocation of 9%, Nvidia with 5.6%, then Alphabet, Tesla, and Microsoft each at around 5%. These are the companies that dominate the fast-growing industries like artificial intelligence, electric vehicles, and cloud computing. Looking at risk profile of CGGR, high returns usually means higher risk. This fund has a beta of 1.15. Beta basically measures how much the fund moves compared to the overall market, which has a beta of 1. So if market goes up or down by 10%, the fund might move 15%, a bit more intense. Now the good thing is the CGGR Sharpe ratio, which shows how much return you get per unit of taking risk is 1.12, and a Sharpe ratio over 1 is generally considered good. So, what is the takeaway? The capital group growth ETF is built for people who want their investments to grow faster than the market average and who are comfortable with little more up and down movement along the way. It holds many of the world's strongest growth companies and has outperformed the S&P 500 since its launch. But remember, because it moves more than the market, it can feel bumpier. If you're okay with some extra swings in your account value, this ETF could be a way to aim for higher longer term gains. Now let's dive into the second ETF, and this ETF is called Vanguard Russell 1000 Growth ETF and the ticker is VOOG. VOOG tracks the Russell 1000 Growth Index, which represents 1000 large US companies that are growing quickly. These are businesses with strong profit growth, new products, and a big market potential. VOOG uses a method called full replication. In a simple terms, that means it holds all stocks in a Russell 1000 growth index in an exact same proportion. Nothing fancy, just copy of the index. Vanguard actually launched this ETF in September of 2010 and it has grown to about $40 billion in assets under management. One reason investors like this ETF, the cost, because the cost is almost nothing. The expense ratio is just 0.07%. That means for every $1,000 you invest, you pay just 70 cents per year in fee. That is cheaper than most of the funds out there. Now, how it has actually performed? Over the past year, VOOG returned about 22.55% compared to 22.58% for the S&P 500. That is almost identical. Over the 3-year period horizon, the average return has been 24.98%, while the S&P return has been 25.03%. And over the 5-year return period, the VOG gained on average 15.17% per year compared to S&P's 15.25. And since its launch, ETF has delivered 16.96% return per year, again very close to S&P's 17.09. So it doesn't usually beat the market, but it tracks growth stocks very tightly, which is exactly the point. The fund invests 100% in large cap companies. The sector breakdown is tilted towards technology, which makes up 59% of the fund. Consumer discretionary is the second, which is about 18%, followed by industrials at 8.6% and healthcare at 6.2%. The top holding big names such as Nvidia with 13.2% allocation, Microsoft with 12.16% allocation, Alphabet with 11%, and Amazon with 5%. Together, these few companies actually make up a big slice of the fund, which means their performance has a huge impact on the ETF. So, what is the takeaway? The takeaway is that VOOG is a simple, low-cost way to own America's fastest growing large companies. It's designed to match the performance of its index, not to beat it. And it has done that job very well for more than a decade. If you want a long-term growth with minimal fees and don't mind some extra volatility, this ETF could fit nicely in your portfolio.